Hi, Greg Lewis, Metastock Software. Hey, you're about to watch one of the great presentations from our recent Online Trader Summit. I know you're going to enjoy it. If you do not yet have Metastock, make sure you visit metastock.com/traders-summit 3-for-1 for a great 3-for-1 offer for Metastock Plus market data. Also, make sure to listen to Jeff Gibby at the end of today's presentation. He has a really great offer. It's very exciting, and I know you're going to want to hear it. Finally, make sure to leave us some feedback. We always want to hear your feedback, and subscribe to our YouTube channel. Thank you so much, and successful trading.
Ryan Jones. So Ryan's brand new to the show. This is the first time he's ever talked to us. And the story of that is I was talking to him about, I'd say about 2 or 3 months ago, and he kind of had some things that were very, very interesting to me that he was talking about around money management. So I was like, well, okay, we're going to do this all-day session with a bunch of our favorite traders and coaches, and I'd really like you to come in and do a class. And so he agreed. Ryan, let's go ahead and bring you on here.
Okay, I am here.
All right, welcome to the Online Trading Summit.
Thank you so much, Jeff. I appreciate it, and it's a privilege to be here.
I want to put you on the spot a little bit, and I'll ask you this the same way I asked Rob. What do you have to say for yourself?
What do I have to say for myself with regard to what?
What do you want to? Is there anything you want to tell us about yourself before you get underway?
Well, I'm that's actually part of the content of the presentation, just simply because it requires context. You know, everybody. There's not a lot of understanding with regard to money management, and so it definitely takes some context to be able to properly understand where it is I'm going and why. All right, there we go.
Looks great. I'll get out of the way.
All right, excellent. I appreciate it again. All right, everyone. Thank you again for attending. You are in for a treat. I know this because I was in for a treat when I discovered what I'm about to present to you today. It was absolutely life-changing. You know, I know a lot of traders. I've been in the industry for a long time. I've talked to thousands of traders. And, you know, one thing I do know is that traders are always looking for that next best thing, right? They're always looking for that next best thing. And a lot of times they don't stick around trading one strategy or this strategy or whatever long enough to really give it a chance. And part of it is because they don't understand the power of what we're going to be talking about today. So I know a lot of traders come in here and they wonder, you know, will I ever actually be successful? Is it really possible to be not only successful in trading, but extraordinarily successful in trading? And you know, there's a lot of guesswork that traders come in and they start. It's like a crapshoot. Well, I'll try this or I'll try that. But I'm going to tell you right now that there's one thing that will absolutely change your perspective on trading, and not just the topic of money management aspect, but I'm talking about everything, how you approach trading. So if you'd like me to share a little bit about that, that's what I'm going to do. And you're about to discover the same thing that I discovered early on in my trading, and it absolutely, completely changed everything. So my promise to you is that by the end of this presentation, you will view trading differently than you have ever viewed it before, and it will be a lifelong change in your perspective. So again, as I was telling Jeff at the beginning, there's a little bit of context behind this whole process of how I came about the discovery of what is critically important for every trader. And I always start with, you know, who I am, because people want to know, okay, who is this guy, and you know, what Why should I listen to them? And I always kind of hesitate with this prospect because everybody's wanting to know about the trading aspect, but who I am is not first and foremost a trader. Who I am first and foremost is I'm a husband, I'm a father, and that is a better definition of who I am. And business is down the list. It's God, family, church, friends, and business. That's who I am. That's my priority. So beyond that, I know y'all are here to find out exactly what it is that I have to say with regard to money management and why it's important. So I'll give you a couple of bullet points, and then I'm going to go into it. First of all, I'm the youngest author to ink a deal with John Wiley and Sons on the topic of futures trading and money management, and I was 26 at the time that I inked that deal. And getting there was quite the journey. But I'm an international speaker. I've spoken in many, many countries. I'm a creator of over 150 hours of trading educational material. I'm creator of over 1,000 strategies, and I'll get back to why that's important here in a minute. But using the material that I've taught and that I've developed over the years, I have the record for the fastest growth to a 600% return in a live trading contest, and it took me 72 days to do that. And I did it day trading the S&P. And on top of that, I've had option signal service that has had 54 winning trades in a row, and that's actual fills during a 1-year period. And over a 5-year period, it had a 93% winning track record. I've doubled and tripled accounts in 90 days trading weekly options. I've done that several times. And my point being is that I have many, many tremendous trading successes under my belt. And it may seem like that these successes have occurred because I've figured out some, special thing in the markets, how to pick market direction or some special aspect with regard to option trading, and that's not the case. It all started completely differently and in a way that most traders don't realize that it would start out this way. So I took my first trade when I was 17, and I ended up losing money. And there are two things that I hate in life. The first is losing, and the second is losing, right? So I don't like losing. And I spent the next 5 years just absolutely going after trading, understanding of trading and trading education, like a pit bull on a raw steak. I mean, I was captured. I was enthralled. I was captured by it. And by the time I was 22, I had traded everything you can possibly imagine, from buying options to selling options to option spreads to buying and selling futures, swing trading, day trading, long-term trend trading. There's nothing out there that I've not seen or tried. And I had a very, very comprehensive experience level by the time I was 22. And in fact, when I was 22, I'd started this trading account when I was 21 and turned 22 in the process. But by the time I was 22, I had doubled a $5,000 account in a very short period of time. That was trading options. And this is the one where I started when I was 21, and 3 months after my 22nd birthday, I had turned a $10,000 account into $23,000 in just 4 months, methodically trading various futures markets using paper charts. This was before the computer was even something that was prevalent in a trader's toolbox, not even a computer, much less software, right? So I was using paper charts. And some of you may even remember those paper charts by the Van Ices, Nick Van Ice and his father. Nonetheless, I remember standing at my kitchen window, and I'm looking out my window. I can picture it as clear as day. And I was married and I had gotten married very early. I was 18 when I got married. 1 year later, had my first child, and we kept having children. But I was married. I had 3 kids. I had a full-time job, and I'm putting myself through college. And I'm thinking to myself, because I had just turned $10,000 into $23,000, and I'm thinking to myself, Ryan, you are all that and a bag of chips. I mean, I thought I was it. And I can remember it as clear as day. And the reason I can remember it clear as day is because it was really stupid of me to start thinking that. And sure enough, it was 3 weeks later, I had nearly blown out that entire $23,000 account. And in fact, I was 14 hours away from graduating college, and I had to drop out because I had just blown out my tuition money, the money that I was going to use for my tuition. I had a family, I had a full-time job, but I also had obviously college, so it was devastating. It was absolutely devastating. And the thing is that wasn't the only time that I had blown out. In fact, every single success that I incurred during that 5 years, and there were several successful experiences, but every single one of them ended ultimately in loss. And not only just loss, but most of the time I blew out the entire account or very close to the entire account. And being as young as I was, I cannot convey to you how devastating that was, especially in the circumstances that I was in. And my world turned upside down really, really quick because I finally thought I had it with that last account, turning it $23,000. And in 3 weeks, it's over. And that's when I said no more. I could not go through that experience not one more time. And I had to figure it out. So I took 6 months and I didn't trade. I took a sabbatical from trading. And I took 6 months and I analyzed this and I looked at various different strategies out there. And that's when I discovered the single biggest contributing factor to my failures. And it was trade size. Okay, let me repeat that. The biggest single contributing factor to my failures was trade size. Now, can I take a minute and tell you why trade size is the biggest determining factor in your overall success as well as failure? It absolutely is. So let me give you a couple of motivational examples. All right. So number one, the one single decision every trader makes before they enter a trade, no matter what they are trading, okay, no matter what you are trading, you are making this decision, and it is a trade size decision. And unfortunately, most traders don't realize the ramifications of what their decision is or what their decision will have. And I'm telling you, if you get trade size wrong, in the long run, it won't matter if you got your entries and exits right. Okay, you might get away with it for a short period of time, but in the long run, it will come back and bite you if you do not have trade size right. I promise you, you can listen. I have horror stories of talking with traders who experience the same thing that I experienced early on, only with much, much bigger accounts. And it is absolutely devastating to hear these stories. And that's one of the reasons why I am so adamant when I come onto these things. I'm like, look, I know it doesn't sound sexy. Yeah, I know it may seem like it's boring and that's not as intriguing as being able to, pick a direction in the market and whatnot. But I'm telling you, you have to focus on trade size in order to be able to capitalize on whatever it is that you're trading. And unfortunately, most gurus don't have a clue as to the importance of this decision. Back when I first started looking at trade size, I'd call my broker, and that's back when you actually called your orders in. You didn't do it over the computer. You called the orders in, right? And so I call my broker and I say, hey, here's my account size. Here's what I'm risking. How many contracts should I trade on this next trade? And invariably, it would almost always be, Ryan, never risk more than 1% to 2% on any given trade. And so I'd have to figure, I'd look at my account size and I'd look at my risk. And I'm saying, well, crap, I'm risking 15% just on one trade, one lot size, one unit. And so, right there, I'm violating the rule. But nonetheless, that's the common wisdom out there. But here's what I want you to do. When you come to this and somebody says, hey, you don't risk more than 1-2% on an even trade, I want you to turn around and I want you to ask them why. Why is that the right trade size? And I'm telling you, they will not know the answer except for the fact that, well, you don't want to risk more than X amount, right? And most of the time, that's not even valid with a lot of traders and their trade size or their account size and whatnot and what they're trading. But nonetheless, they're not going to have any explanation for you other than, well, it's just smart not to risk more than 1-2%. Well, what are the ramifications of that? And I'm here to tell you that the ramifications are that you are leaving thousands of dollars on the table, tens of thousands of dollars on the table, and or you're risking way more than you need to risk. All right, so I want to change your perspective in this. And I like this saying, be careful how you interpret the world. It is like that, right? So be careful how you interpret trading. It is like that. And so I want to change your perspective. And when you understand proper money management, and that understanding will give you a different perspective across the board, across everything. You will look at the charts differently. You will look at your trading strategy differently, or you will look at various trading strategies differently, and you will make different decisions. I guarantee it, you will make different decisions. So there are three major and specific changes in perspective that will come from understanding proper trade size. Okay, the first perspective is that your primary focus will no longer be on where to get in and where to get out of the markets. And this is a very dangerous focus, where to get in, where to get out of the markets. And it's not, you have to address it. Don't get me wrong. You absolutely have to address it. But if that's your main primary focus, you're focusing on 10% while you're leaving 90% undone. Okay, so it's not your primary focus now. It should be your secondary focus. Okay, and you're gonna know why here in a few minutes. So stick with me. And I know I'm preaching counterintuitive here, but I've been doing this a long time. And if there's anything that most traders should know, it's that whatever they think intuitively with the markets, it's probably not right. All right, so tell me I'm wrong. All right, so number two, you're no longer searching for that holy grail strategy. Okay, we are discontent as traders. Nothing is ever good enough. And you know why? It's kind of like golf. It's something where you will never, ever, ever, ever be perfect at. And I'm not going to go to a golf course and I'm never going to hit 18 holes in one, right? It's never going to happen. And trading, it's kind of the same way. It doesn't matter where you get in, where you get out, it's never exactly right. The market always moves higher or lower. You always could have got a better price. You always could have stayed in for a better profit. You always got out too soon, or you always got out too late. You're never ever perfect. And that's very difficult for traders to grasp. And so we go from one thing to the next. And if we're not making $1 million in 5 weeks, we need to find that one strategy that does it. And I'm telling you, there is no strategy that does it. It doesn't exist. Your search is in vain. The Holy Grail strategy does not exist. So it's going to change your focus because you don't need the Holy Grail strategy to do really, really well. All right. Number three, you're no longer switching from strategy to strategy every few months. As long as your perspective changes properly, you will understand that you need to find something, apply the proper money management, and stick with it. And you'll have the ability and the confidence to stick with it because it's not the strategy that is going to be the propelling of your account. So your new perspective is the antithesis of these three things, and that's because you realize that exponential growth comes from compounding what? A little, not a lot. Exponential growth can come from compounding a little. You do not need to make a killing in the markets. You don't need to risk thousands of dollars a day to try and make $1,000 a day or $100 a day or $500 a day or $500 a week. You don't need to risk all of this money in order to be able to do really, really well. You can start off risking very, very little and then compounding it if you know how to properly compound. So the first goal of trading is always, and this is money management, okay? It is always, 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 what do you think it is? The first goal of trading is always, and this is what I tell traders over and over and over and over again because I experienced it when it was not my first goal, and I've seen tens of hundreds of thousands of traders fall into this trap and fall because this was not their first and primary goal. It's survival. Your first and primary goal in trading is survival. If you cannot survive, you cannot experience growth, you cannot experience success, you cannot experience extraordinary success either. So you must survive. And what does that mean? Well, that means you start with one unit, trading one unit. If it's futures, one contract. If it's options, one option. If it's stocks, maybe 100 lots of stock, and one unit is 100 lot of stocks, or whatever it is. In today's environment, you can trade all sorts of trade sizes in stocks as well. So whatever one unit is, whatever the minimum unit is, that's what you start with. I don't care how much money you have. I don't care what successes you have had in business, lawyers, doctors, airline pilots. I've talked to them all, discussed all of this, all of these things with everybody you can possibly imagine, and have stories where they thought that their success in one area translated automatically into success in trading. And the fact that they could have a $100,000 trading account automatically meant that they could risk, 10 grand, 20 grand, 30 grand, whatever it is that they were risking, and then end up doing a lot worse than that, right? So it means you start with one. Counterintuitive, but you start with one because you're going to see that growth comes through compounding. So to prove this, I'm going to play a little game with you. And this game is fairly simple. And if it was offered in Vegas, I would live in Vegas. All right. So I'm going to flip a coin in the air 100 times. And theoretically, I'm not really going to take the time to do it here, but theoretically, I'm going to flip a coin in the air 100 times. And every time it lands heads up, you're going to win $2 for every $1 you bet. Okay. So you flip the coin in the air. If it lands heads up, you win $2 for every $1 you bet. But if it lands tails up, you're going to lose only $1 for every $1 you bet. All right. So in a 50-50 situation, which is what a coin flip is, in a 50-50 situation, you have a win-loss ratio that's 2.0, right? So you win 50% of the time with a win-loss ratio that's 2 to 1. All right, that's this game. The mathematical probabilities are fixed in your favor. Now, I understand this is not trading. It's for illustration purposes only. All right, so that's the game. Now, what I'm going to do is I'm going to give you a $100 account to bet with, and your goal is to maximize the profit after 100 flips of the coin. All right. So how much do you risk on each flip of the coin? It's a mathematical positive. The probabilities are mathematically fixed in your favor, so you can't lose. How much of your $100 do you bet on each flip in order to maximize this guaranteed for sure winning system? Okay, that's my question to you. And I want to tell you right now, if you don't know the answer to that question, if you do not know the answer to this question in this scenario right now, you do not know the answer to your trade size based on what you're trading right now. Guarantee it. You don't know what the right answer is. And that, unfortunately, that's should be an eye-opening statement for you with regard to how much unfortunately, this industry does not focus on proper trade size. All right, so now if you're probably guessing, I see a lot of guesses there. It's great, but I'm going to make it easy for you. All right, now this is a no-lose situation. Most traders don't have a clue where to start, so I'm going to make it simple for you, and I'm going to give you 4 choices. All right, so it's a multiple choice test. You're going to risk 10% of your account on each flip of the coin, or 25% of the account on each flip of the coin, or 40%, or 51%. And again, remember, your goal is to maximize the profits. It's not survival in this example. All right, it's to maximize the profits, which is usually what the normal goal is with most traders anyway. It's not survival, it's to maximize profits. But I say survival. But in this game, for this purpose, your goal is to maximize profits. All right, so go ahead and choose which one you think is going to work out, and then let's see what the answers are. All right, so if you chose A, if you said, I'm going to risk 10% of my $100, what that means is that if you risk $10 on the first trade, which you would do, and you won, then you would win $20, and now you have $120 in your account. And on the next flip of the coin, you would risk $12, which is 10% of the new value. That's how it works, right? So if you chose 10% and flip that coin 100 times, and assuming that during that 100 times it was 50-50, we're going to go ahead and make that assumption. What do you think your account would turn into after that $100, after that 100 flips? All right, well, here is what it would turn into. That account would turn into, whoops, hang on one second. For some reason, it just went off my slideshow. So let's see. Well, now I'm going to have to go through there. Hang on. I don't know why it did that. Design, let's see here, slideshow. And all right, for some reason it is not showing the slideshow. Can everybody still see that? Yeah, I must have lost on that coin flip.
We can still see it, just not in the presented, like the full screen mode. So
okay, let's see here. How's that? There we go. I apologize. So
looks
you risk
perfect.
10%. All right, perfect. Thanks, Jeff. If you risk 10% of the account on each flip of the coin, your $100 turns into $4,700. That's tremendous. Now, if you didn't use any money management, you just said, okay, I'm only gonna bet $1 on each flip, you would have $50 in profits. So your $100 would turn into $150 with no money management, no trade size difference whatsoever. But by risking 10% of your account on each flip of the coin, $100 turns into $4,700. That's tremendous. That's incredible, actually. So what about the 25%? Well, if you chose 25% of the account on each flip of the coin, your $100 turns into a whopping $36,100. That is incredible, and it does not matter in which order the wins or losses came. All right, it simply does not matter. It will occur at the same time as long as those stats are what I gave you. So, man, at 25%, you're definitely going in the right direction. That is a tremendous, tremendous return. So now, man, for those of you who chose 40%, if you chose 40%, what do you think? Well, it turns your $100 into $4,700. All right, 40. So you're now going the wrong direction. And if you chose 51%, your guaranteed winning strategy, mathematically guaranteed winning strategy, turns your $100 into $31. You lost money. Is that Is that not absolutely mind-boggling that you could, by your trade size decision, you can turn a winning situation into a losing situation? All right, now that was a coin flip example. I understand that there is some relevance there and there's not relevant. The purpose was not to tell you what trade size to use. It was to hopefully open your mind and your eyes to the importance and the destruction of trade size decisions, the power and the destruction of trade size decisions. So please don't come back and say, oh, Ryan told me to risk 25% of my account on every trade. That's not what I said. So it was just for that example. All right. So what is relevant about this example then? Well, the power of money management is geometric. All right. It is geometric, and it will be geometric in your trading account as well if you have a profitable trading strategy. Number two, the money management has the power to perform a mediocre performing strategy into a ridiculously profitable experience, into a ridiculously profitable account. Money management has the ability to turn a mediocre performing strategy into a ridiculously profitable experience. All right, so that's what's relevant with regard to this example. What's not relevant? This is not the money management strategy to use. Okay, and this does not address the first and foremost goal in trading, which is survival. So I always say start with one unit, one whatever contract, et cetera, and survive, and then begin to determine your trade size. Right. So this is a very powerful illustration that I use. And the reason I use it is because it's the one that I looked at during that 6-month period, and had just gone through 5 years of success and bust, success and bust, success and bust, and it was that example that said, oh wait, you know what? I have not paid any attention whatsoever to the ramifications or the consequences of my trade size decisions, and I was just willy-nillying it. It was off the cuff. It was shooting from the hip. It was whatever I felt like trading. It was whatever I felt like risking on this particular trade, and it was absolutely a mistake. It was awful to do that, right? So that's why I use that in this, because it's what turned my perspective around. And it's, again, not just about success in trading, it's about extraordinary success. I would tell you that whatever strategy that you're looking at, it may give you the ability to be successful, but it does not have the ability to give you extraordinary success without proper money management, without proper trade size. All right, so very, very important. Now I'm spending a little bit of time on this because most traders have never heard it. Most traders don't spend a lot of time. Most traders are bored by it. But I always ask, I use this information, and a few years after I learned it, by applying it, I turned a $15,000 account into $107,000 in 72 days. All right, and I would go so far as to say most traders don't do that in the lifetime, much less in 72 days. Well, it wasn't the strategy that I was trading. Yes, it was. Yeah, the strategy that I was trading was profitable, but it was the money management that allowed me to grow and experience that kind of success in such a short period of time. And I started with a trade size of 1 unit. Okay, and that was day trading the S&P, and it doesn't matter what you trade, whether it's options or day trading or swing trading or whatever the case is. You need to make sure that you know how to apply proper money management. So what is money management exactly? When I'm talking about it, a lot of people get it confused with, hey, I'm going to put a money management stop in place. Okay, well, that's trade management. All right, that has nothing to do with your overall account. Trade size has to do with your overall account. Yeah, your stop may determine your risk on one trade, right? And then based on that, however many that you're trading, that's going to be the context of your overall account. But what you need to know is you need to know exactly when to increase your trade size, when you want to go from 1 unit to 2 units, and why, by the way. When you want to go to 1 unit, from 1 unit to 2 units, and then from 2 units to 3 units, and from 3 units to 4 units, et cetera, right? And then when to decrease your trade size. If you get to 4 units or 5 units, and then all of a sudden your strategy stops working, what do? And you start to decrease your trade size. You have to know when to decrease from 5 to 4, from 4 to 3, maybe even all the way back down to 1, which I've done several times before, and it saved my rear end. All right, so those are the two questions that you have to ask yourself, and you have to understand, and you have to know before you ever start trading whatever strategy it is that you decide that you're going to start trading. And again, the industry says never risk more than 1 to 2% on any given trade. Now, let me show you something and show you why that is in 99% of the cases, that is not the correct answer. And this is a graph of the 1% and 2%, which is the blue line is 1%, the red line is 2%, and then the orange line is my approach, which is called the fixed ratio approach. And this is a coin flip, and this was actually sent to me by a client who went through my presentation and wanted to test out what I was saying. And so he literally flipped a coin 100 times, bet $100 on a $5,000 account with each flip, or actually I think he bet $50 with each flip, and he was only right 44% of the time. All right, and for the first, I don't know, 20, 25 flips, the thing was break even. But then it began to make money. And as it began to make money, the blue line, which is 1%, is what is the compounding end result of his coin flipping measure. The red line is 2% applying to that same strategy, if you will, strategy, quote unquote. And then the orange line is the fixed ratio approach being applied to a very conservative variation of the fixed ratio approach. And you can see here the results are tremendously different, which is why I say that you could be leaving thousands, tens of thousands, maybe even hundreds of thousands of dollars on the table, not because you didn't get in at the right place or get out at the right place, but because you didn't have the right trade size while you were trading whatever it is that you were trading. All right, so that just kind of gives you an illustration of, and this is on a very, very slow performing coin flip example that is not all that far from how some strategies perform. 45% correct with the 2-to-1 win-loss ratio. There are several strategies that give you those kinds of performance statistics, right? And so the key is to number one goal, survive, and then 2, apply the proper money management so that you can compound it. And it works on anything. Okay, proper money management works on anything. It works on futures trading, stock trading, option trading, spread trading, swing trading, day trading, long-term trading, doesn't matter. It works on everything. And the reason that it works on everything is because everything ultimately boiled down provides a profit or loss, right? And so I don't care where that profit or loss came from. It works because it's math. It's not about market direction. It's not about the strategy that you're trading. It's about whether you are making money or not making money. And if you're making money, it's going to maximize what you make off of that. And if you aren't making money, it's going to minimize your losses, because you're going to have started with the first goal, which is survival. Okay, I'm giving you here information that may seem really simple, but most traders don't follow it. especially during the beginning years, first 1, 2, 3, 4, 5, sometimes even 10 years of trading before they realize that, oh, you know what, maybe I shouldn't be so risky when I start trading something, right? So the parameters need to be adjusted to take advantage of whatever it is that you're trading based on the overall risk associated with that strategy, or whatever risk you're willing to take with that strategy. So you do need to make an adjustment with regard to the risk in order to account for that. So every strategy is not treated exactly the same, but it's the same overall approach. The general money management approach can be applied to anything, and it's just a matter of how efficiently you apply the strategy. So don't use anything that you're trading. Oh, well, I'm doing this, so I can't necessarily apply your approach. Well, that's probably not going to be true. I don't care what it is you're trading. You can probably apply this approach, my fixed ratio approach, to your strategy. All right, and so I'm going to give you a trading plan that is designed to take a $5,000 account and grow it into $1 million in 5 years. And most people think, well, that's nuts, and it's really not that. It's really not nuts. If you can get the right approach, it's not nuts. And the reason is because the compounding is really, really where the power comes from. All right. So, what does it take to turn a $5,000 account into $1 million in 5 years? This is going to shock you. It's absolutely going to blow your mind what it takes. And this is why I say that the money management changes your perspective, not only on trade size, but on what it is that you're trading. All right. This is why. It's not just about the trade size. It also will change your perspective and change your outlook on what it is that you're looking to trade and what it is that you're expecting from the underlying strategy that you're trading. So what does it take for a $5,000 account to grow into 1 million in 5 years? Well, if you can average just $60 per week in profits based on 1 unit, while keeping the drawdown to about $500, then you can turn a $5,000 account into $1 million in 5 years. Doesn't matter what you're trading, okay? Whether it's option trading or short-term swing trading or day trading. If you can keep your drawdown at within a certain reason, all you got to do is make $60. Now, what happens is when most people are trading something that has a little bit more risk, their drawdown, let's say maybe $500 or $5,000. All right, if your drawdown is $5,000, then obviously you can't trade a $5,000 account, right? Because you run the risk of not surviving, and your first goal is survival. So if you only have a $5,000 account, you can't trade anything that has a $5,000 drawdown anyway. And if you do, it's not smart. So you have to you automatically, by your account size, you automatically have to trade something that has lower risk. And by the fact that it has lower risk, you're not going to make as much. Period. There is no magic bullet out there. There is no holy grail out there. If you're risking X amount, there's only so much that the market can give you. Period. Right. So if the strategy that you choose has really low risk and the overall drawdown is only about $500, well, if you can average $60 per week, then you can turn $5,000 into $1 million. And here's the table, and this is the fixed ratio strategy. I'm not going to give you all the mathematics behind it because time definitely does not allow for that in this situation. But I am going to show you what it is. I'm going to completely and fully reveal it here, just simply without giving you all the mathematical calculations. So I'll give you the understanding of it. And I realize, some people say, hey, I don't need to understand how the engine works in order to drive a car. I just need to push the gas pedal and push to go and push the brake pedal to stop, right? And that, that's certainly valid. That's true. But I'm going to encourage you that if you apply money management, you're going to be able to apply it better if you understand how it works. All right. So here's how this works. Basically, you start with $5,000 account. You start trade size with a unit of 1. All right. This is 1 unit. And when your account, your closed trade account balance goes to 5,100, then on the next new trade, you're going to go to 2 units, whatever that is. If it's options, you go to 2 options. And if it's 100 lots, let's say you have a very low risk day trading strategy, then you may go to 200 lots. So 100 lot would be 1 unit, 200 lots would be 2 units, right? So at 5,300, once your closed trade account balance goes to 5,300, then you would go to 3 units, and so forth and so forth. And you just go down this table. So at 10,500, right? 10,500. Once your account goes to that level, then you trade 11 units, and et cetera, et cetera. And if your account begins to drop, if your strategy is now no longer working the way it was, which happens all the time, then you begin to decrease your trade size because you want to survive and or protect profits. You want to survive and or protect profits. And so you begin to lower your trade size, all right? And you just follow this. And if you can average $60 a week based on 1 unit for 5 years, that'll turn into more than $1 million. And it's math. It's not, again, if you overlay the statistics, the performance, it will compound it in a very similar fashion. It may not be exact, but it will compound it in a very similar fashion. So that's the beginning. Let me run down here and go to the end. Okay, so here's the end of it. You can see that by the time you get to $1 million, your $5,000 turns into $1 million. You're trading 143 units. All right, you might say, wow, that's trading a lot of units at that point. Well, yeah, but if you suffer the $500 drawdown, let's say you get to $1 million, you suffer the $5 million drawdown at that point, or $5 million, $500 drawdown at that point, and you do it with 143 lots, right? That's $71,000. So you just dropped 7%. Now, instead of having $1 million, you have basically 930,000. All right. So that sometimes, that's the worst case scenario. That's your worst drawdown being realized, and it may exceed that at that point. But you're decreasing. You should be decreasing trade size as it goes on. Then you'll, at some point, you'll have an if that drawdown continues, you're going to say, okay, the strategy has stopped working. If you're $500, you expected no more than a $500 drawdown, and then all of a sudden you have a $1,000 drawdown. Then you got to start questioning whether the strategy is still working, whether it's still valid, or whether you just had a really good run. So that's how it works. Now look at the right side column. Okay, if I did not compound this, the $5,000 account during that 5-year period only would turn into about $14,000. In other words, it's $9,000 in non-compounded profits. That's it. All right, $9,000 in non-compounded. That is not that great of a return for risking what you're risking 10%, right? 5,000 drawdown, risking about 500. That's 10%. So that is not that impressive of a return. In fact, I would say that most traders, if they were trading something like this and their growth was that slow, they would stop trading it within months. Even though it was working, it's not getting them to where they want to be, and it's because they expect the strategy itself to get them where they want to be, as opposed to the combination of a strategy and money management. All right, so let's say you can't average $60 a week. Well, here I've given you a table based on the exact plan, and that's what it is. It's a money management plan. based on a certain type of strategy. If you could only average $10 a week, you're still looking at compounding your $5,000 into $38,000 after 5 years. At just $10 a week. At $20 a week, look at the jump in that. At $20, if you can just average $20 a week, you can compound a $5,000 account into $140,000 in 5 years. Now, I'm telling you, you can't get into a stock and put $5,000 into a stock and grow a $5,000 account into $140,000 in 5 years. It's almost impossible. It has happened before with some stock movements, but very rare, very few, far between, and you're not going to do it. I'm telling you right now, you're not going to do it. So that's not where you want to put your hope, right? You want to put your hope in something that will be able to explode a little bit, and that's what this does. So let me ask you this question. I said that it would change perspective. It would change your perspective. If you realize that you only need to average $20 a week while risking, let's say a $500 drawdown, if you can only average $20 a week and you can compound a $5,000 account into $140,000 in 5 years, does that change your perspective on what it is that you might be willing to trade? Maybe you'd be willing to trade something that doesn't look as sexy on paper without money management, but you add money management and all of a sudden, wow, it has that wow factor. Does that not change what you look for? It did me. It absolutely changed the way I looked at everything with regard to trading. It changed the way I looked at strategy building. I mentioned that I've developed 1,000 strategies before, and I'm always looking. And this is back when I was doing stuff in Supercharts and TradeStation. I don't do that anymore. I don't need to do that anymore. But that's part of the time when I was doing that, and MetaStocks. I know a lot of you, obviously programming in MetaStocks now, and I don't do any of that programming. I don't need to do any of that programming, and I'm not developing any of those strategies. There are plenty of good strategies out there, right? I don't need to reinvent the wheel on all of that. But if you can just find a reliable, doesn't have to be tremendously sexy, it's just a reliable strategy that produces a little bit with a low risk, you can really grow a small account fairly quickly. All right. So if you want a copy of that, I think they gave you an opportunity to get a copy. We will be sending that out early next week if you requested a copy of that. Again, that is specifically for an option strategy that I trade, and it's a weekly option strategy that I trade. And you can certainly get information about that weekly option strategy that I use this plan on as well, which, by the way, is not even was not available before February of this year. The strategy that I'm trading now was not available before February this year because of what they're doing in SPY with weekly options. They have Monday, Wednesday, and Friday with weekly options now, if you can believe that. So it's a tremendous opportunity for short-term option traders. But nonetheless, that is, you can go to fixedratio.com to find out more information. I actually have a 10-hour money management course. So if you want to know how the engine works, that's where you want to go. There's a lot of detail there. But I promise you, you will know more than 99% of all traders know about money management when you go through that course. And then my short-term options stuff can be found at paydaystocks.com. That's paydaystocks.com. All right. So I only touched the tip of the iceberg today. Again, there's so much more with regard to money management and being efficient with it, and being able to properly apply it to whatever strategy it is you're trading. So I'd strongly encourage you to go through that course, and hopefully you've enjoyed today's presentation. I look forward to hearing from you in the future. All right, Jeff, I believe I am right on time.
Yeah, you are. Well, you're close.
I'm close. I'm close.
Do you have time for a couple questions?
Absolutely.
All right. So a question that came up quite a bit was for stock trading. Obviously, you probably wouldn't recommend somebody buy one share at a time.
Right. So one unit can be, 100 shares. So, whatever you do, I would be consistent with whatever one unit is. So you can buy, 50 shares, and that can be one unit. And so what you would want to do is you would say, okay, I'm buying 50 shares now, and when my account grows to, X amount on my next trade, I would then go to 2 units, which would be 100 shares, and then at 3 units it would be 150 shares, and then 4 units would be 200 shares, et cetera, et cetera. Does that make sense?
Sure.
Okay,
Sure.
great.
Let's see. We have a lot of people that want to get more information on the math you're using. Is there a way that they could reach out to you or somebody in your company?
Yeah, I provide some information on fixedratio.com, and then they can also reach out to support at paydaystocks.com and get more information through that as well.
Okay, awesome. Thank you very much for your time today.
You bet.
Appreciate it.
I appreciate being on.
Okay, we'll see you soon.
All right, take care.